Welcome to Peaks and Portfolios, presented by Peg Companies, your go-to podcast for all things commercial real estate investment. I'm Rachel O, and together we're diving into current events, trends, issues, and opportunities impacting the CRE investment space. From dissecting the latest market moves to sharing insights on today's commercial real estate landscape, it's time to maximize portfolios here in the Peaks of the Mountain West and beyond. Okay, welcome everybody from the Peaks of the Mountain West, high up here on the Wasatch Front. We are excited again to talk real estate, the economy, and anything else that may come about. Thank you for joining us today for this week's episode of Peaks and Portfolios. You know, over the weeks, we have covered various topics, including the Fed funds rate, office to multifamily conversion, securing debt in this environment. I wanted to shift gears a little bit and kind of talk about private credit, which is actually experiencing an extraordinary moment due to cyclical and secular trends in the real estate lending environment. And to help us better understand what's happening in the real estate credit markets, we are pleased to have our esteemed guest and my new boss, Garett Bjorkman, Co-Chief Executive Officer for Peg Companies. Welcome, Garett.
Thank you, Rachel.
So what are we now in, day 12?
I think it's day 12. Yeah.
So what do you think? What do you
It's
think
amazing.
about
It's
altitude
amazing.
here? Anything?
The altitude's great. I think it makes me move a little bit more fluid, a little quicker. It's good. It's good. We're moving fast.
Yeah. How about you missing Scottsdale?
You know, I'm missing my kids a little bit since they're not here yet. But other than that, loving being in
Well,
the
let's
mountains
get
right
them
now.
here.
Well, they're coming soon. They're coming
Utah,
soon.
it's very kid friendly. I don't know if you've noticed.
I've noticed. There's a lot of them, and they're coming. They're coming.
We aren't the fastest growing state in the union for no reason.
I know. Number one state I saw.
Yes, in the last census count, I don't know if everyone knows, but 2010 to 2020, we were the fastest growing state in the entire union.
Yeah.
So
amazing.
It's a good place.
Yeah.
So in preparation for today's podcast, I did dig into your bio a bit more, which I'm going to go into, but it does turn out that you studied in Shanghai. So ni hao ma?
Yeah, ni hao. Yes. In 2008, I studied in Shanghai.
Okay.
Mm-hmm.
And how fluent are you in Mandarin?
Conversationally, I'm okay, but definitely not fluent. I'm working on it. My kids are in Mandarin immersion.
Oh,
and
excellent. 很好.
Yeah, 很好. So we're trying to get them there, and I'm trying to get there with them.
Okay. Well, I feel
in my free time. That's what I'm going to be focused on.
I feel like there's some offshore activity in the future.
Yeah, we hope so. Once those capital constraints ease up.
Well, good. Let's talk about that a little more. So just so the audience is better acquainted with you, I'm going to share a little bit about your background. Garett has had significant experience in the financial and real estate industry. Started off his career at JCR Capital Investment and Thoroughfare Capital with roles in research and capital markets. In 2015, Garett became a managing director at the CIM Group, which is where you came from, a real estate and infrastructure investment firm where he managed CIM's credit platform, which grew to $10 billion, and also oversaw a build-to-core equity deployment strategy to over about $2.5 billion, if I have that right. And since May 1st of this year, Garett is now the co-chief executive officer of Peg Companies. We are a 20-plus year vertically integrated real estate investment firm with over $2.7 billion AUM. And as I mentioned before, he is my new boss. So thank you, boss, for joining us today. So as I started off, we are seeing private credit is experiencing increased opportunities due to the changing trends in the real estate lending environment. The great financial crisis and recent bank failures have led to greater regulation and limited traditional capital availability and rising interest rates. The cap stack has changed. So this is where you came from. So I was wondering to see, if you could tell us a little bit about what is happening in the real estate credit markets and how is that impacting the opportunities we are seeing today?
Yeah, no, it's a great question. So let's just take a step back, and I think big picture, going back to the GFC to understand what was happening that caused a lot of issues to happen with lending and why regulators moved in a big way and really created the market for private credit. So if you just think about how banks work, right? Banks take deposits and deposits have daily liquidity, right? And then banks go and take those deposits and make loans and invest in assets that are illiquid or less liquid. And there is a fundamental mismatch between the liquidity of the assets and liabilities on a bank's balance sheet, right? And so I think that's always been a fundamental problem that many people have seen in the banking industry in general. And it's one of the things that has really created the regional banking crisis, last year. Mm-hmm. And it was that same issue of, people wanting their deposits out at the same time when banks had invested in securities that were longer dated and didn't have that same maturity. And so kind of that aspect, I think, combined with the fact that banks historically were investing in real estate assets that had some kind of transitional element to it, whether it was a value add play to increase occupancy, increase rents, or some sort of construction component. That just wasn't what banks did, and they weren't good at managing that risk.
Right.
And so, Dodd-Frank and Basel III were really the regulations coming out of the GFC that created the void for private credit to start coming into the space. And it was really focused on, changing the capital requirements for banks to make the capital charges so punitive to the extent that banks were lending on these kind of transitional assets at higher leverage levels. And so, private capital came in to fill that void. Mm-hmm. So whereas banks would now kind of lend up to, call it 50% loan to value, whereas historically they were lending 75, 80%,
yeah.
Pre-GFC. Now banks are lending kind of 50%, and then private capital's coming in and filling that void from 50 to 75. So it was a space that has become, now it's an institutional asset class, right? Mm-hmm. It's in pretty much every institutional portfolio allocation. There's for private credit, and I think more frequently real estate credit,
right,
in institutional portfolio allocations. And, there's been mortgage REITs that have been formed. There's private funds that have been formed really to fill that void. And they've become a really major player in the real estate market. And so kind of their active participation and their ability to provide liquidity to the market is a key factor in transaction volume occurring, for owners being able to refinance loans to acquire properties. The standards at which private capital is able to lend is critical for the market to exist.
Right. We talk about this, and I've mentioned this in a few different episodes, is this looming debt situation that's coming about, right? They say it's unprecedented. I mean, I've heard billions, I've heard trillions, and I understand there's groups that are accustomed to paying, 3-4%, and now with a refi event coming, you're upwards of 7-8 plus. And so is that then setting the stage for even a bigger opportunity for private credit? Like, how is private credit seeing, kind of the landscape? Because it does seem like it's on everyone's minds right now.
Yeah, so I think, look, the banks are getting continued pressure by the regulators after the regional banking crisis to shore up their balance sheet and reduce their exposure to commercial real estate, in particular in office. So let's just talk about, liquidity in the market. I think there's a few factors that you need to consider. Short term, there's liquidity pressures on owners of real estate because most of the transitional lending that was done in the floating rate context. So, think back to 2020, we're just coming out of COVID, interest rates are at zero. 2020 had the highest volume of commercial real estate activity in U.S. history.
Which is crazy to me because the whole world was like at home with masks, can't go out, and yet we're just lending like crazy.
There's so much, right? Money supply was high. It was all the stimulus. Interest rates are at zero. And people were buying, not necessarily going in, actually at the time they were going into office, thinking there would be a quick rebound.
Yeah.
But, all of that transitional debt was basically floating rate debt. And a lot of that was issued by the private markets was structured with 3-year initial maturities with 2 1-year extension options.
Yeah, I hear
And
that all the time.
that's how you structure the loans, and that's just industry practice. So, all of those loans that were taken out in 2020 are now coming due 2023, 24, 25. And it's also happening at the same time when long-term rates, in terms of if you look at the Treasury, which has been just bumping around 4.5%, is up in a significant way from where it was. If you look kind of at how do people value real estate and how do you think about cap rates and you think about long-term rates, people have always looked for some premium to the risk-free rate to be buying real estate, and people have looked to the 10-year Treasury as a risk-free rate. Whereas, you go back to 2020, again, look at apartments, right? The fundamentals of apartments, there was an undersupply of housing. We were seeing strong rent growth. The fundamentals really made sense for multifamily development, and so people were willing to lend high on multifamily. People were willing to pay high amounts and low cap rates because of those strong fundamentals. What they weren't expecting was that long-term interest rates were going to make the shift that they have, in that all of a sudden now you can buy 10-year Treasuries for 4.5%. And now people are going to want some premium to that 10-year when they're valuing the underlying asset.
Sure.
So let's just say on average, people maybe want 130, 150 basis point premium to the 10-year in order to say, hey, the incremental risk through owning this asset is worth it. That means, 25, 30% discount from peak values on multifamily, despite the fundamentals still remaining relatively strong.
Yeah.
So when that's kind of the overall market dynamic, and then go back and think about, all of the lenders, the private lenders who were lending in those years, who were the issuers of those loans. And, these loans are now maturing, and, they are having very difficult conversations with the owners of these assets,
right,
who are their borrowers, in terms of, what does it take to give me more time? And lenders are asking, is my loan impaired, right? Is the value of the asset gone lower than my loan amount? And I think we're in a really interesting time, because if you look at, especially in the multifamily space, which is a space where people never really anticipated this would happen, because cap rates were so low, and we've seen values now decline because of this capital markets shift in long-term rates. There's many lenders now who really are impaired in the debt fund space, because they were actively lending at 75 to 80%.
Which is crazy to me, because just fundamentally, and I'm sure you'll carry on the tradition, we've never hit that. I don't think we've always been very conservative.
Yeah.
I mean, I think we've always been at like 50, 60. Well, actually, that's not true. There's probably a period where we were maybe at 75, but in general, in the last 5 years, it's been 60%.
Yeah. I mean, going through our book since I've been here, I think I've been really pleased with the conservative and disciplined way in which we've leveraged. We've leveraged with, strong banking relationships, where I think we've designed the relationships strategically such that no one project is worth blowing up the entire relationship.
Sure.
And we're working together to get through issues. But you're absolutely right. I think banks are willing to work with us because of the fact that we have so low leverage, and nobody feels like they really are impaired.
Yeah.
And so we've had a lot of cooperation with our banks, people willing to give us time. I think on the debt fund side, it's different in the sense that, a lot of these debt funds, the way that they utilize leverage was with a real lack of discipline. And, as the market got really competitive, in order to drive their cost of funds down, in order to originate loans, the public mortgage REITs, the private debt funds, they would easily take on 4 times leverage, 4 times being their debt to equity ratio, or, effectively 80% of the senior loan, they would go out and get financed in these structures from banks. And it's kind of funny. I mean, unfortunate but funny, but it goes back to the same issue, which is the fundamental issue in the banking system is a lot of these debt funds have borrowed short and lent long.
Yeah.
Right. So they've borrowed, 4 times leverage on credit facilities that have durations that don't match the underlying loans.
Yeah.
So, if you look at the public mortgage REITs, they're trading at prices that are really way down.
Yep.
Right. And I think it's not just because of, hey, we think that value's impaired. I think that there's a perception and a reality that as these loans have issues, these entities, these funds, they're going to get pressure from the banks to be paying down debt. And where is that liquidity going to come from?
Right.
And so, there's real liquidity issues, which I think is what is causing a lot of people to say, hey, there's going to be a lot of near-term opportunity to see, one, these debt funds are going to be putting pressure on their borrowers to be kind of forced sellers to sell assets to generate liquidity so they can pay back their loans,
Sure.
which is something that's very different from the GFC, right? In the GFC, you had the Fed, which was going to say, hey, just wait and we're going to kind of look the other way.
Right. Yeah,
that's not the
over.
case here, right? So I think there's different players that are going to be the catalyst for forced sales as these loans do mature, in particular from the private lenders who are making higher advance rate loans and are having to deal with their own liquidity issues. And, I think that is going to lead to distress sales from a capital markets perspective.
I keep hearing that, and I'm just curious, is it really happening, right?
Yeah. So it's happening. I would say we're seeing it. It's happening very quietly, right? And I would say over the past 2.5 years, you've seen the headlines of people handing back the keys on office assets.
Right. Office, absolutely.
Large office assets, right? And there's been no fighting. It's just been take back the keys. We're not no negotiations, right? Everybody's kind of said take the keys. And now the banks are just sitting on it. I think where we're at now, and we're just again early, is in the multi-sector, is all of this stuff that was, I think people had hope that long-term rates were going to come down, that, maybe we would get some relief sooner in terms of interest rates. And people last year, I think, were willing to put in some money to get extensions, and banks and debt funds were willing to work with those borrowers to give them a little bit more time. But there does seem to be more consensus in the market that interest rates are going to stay higher for longer. And it seems like every time the Fed speaks, they feel more and more comfortable with keeping rates at the levels that they are. And so, to the extent that things stay constant and you just kind of apply the simple math that we talked about before about having a 120 to 130 basis point spread over the 10-year, and we have a 30% decline from peak valuations in multifamily, once that reality sets in, and lenders are saying, hey, we're impaired, they have to take some action, right? So we are seeing it. I think we're relatively early, but it is happening. But, we're seeing people go out and raise preferred equity. We're seeing people have to go out and raise mezzanine loans, right?
Yeah.
We're seeing people have to get creative in order to meet extensions, but these debt funds are looking for cash, and people are capital constrained.
Yeah. So that all sounds like opportunity, as you mentioned all that.
Yeah. I mean, look, I think that's absolutely where we're focused right now, right? I mean, we're not super focused on the debt side of things here at PEG, at least yet. But I think that debt is certainly going to be the catalyst for a lot of opportunity in the near term. And I think it's going to give us the ability to be acquiring assets below what we believe to be long-term intrinsic value.
Yeah.
And, look, it's tough to build right now, right? There are markets where building absolutely still makes sense. We're seeing it. Obviously, given the fundamentals in the residential sector, there's still opportunities. We're seeing it in build for rent, right? We're still seeing
there is
really
no build for rent, so you have to have a build for rent.
Yeah, I mean, the build for rent is still where we're seeing strong equity coming in, and this select service limited hospitality strategy that we have, we're still able to build to levels that make a lot of sense. But the acquisition opportunities of distress asset, I shouldn't say distress assets because they're really performing assets with strong long-term fundamentals that just have distressed capital
anything.
stacks.
I mean, you buy the right,
Yeah, I mean, these are good, high-quality assets that were just over-levered, and there's liquidity constraints, and there's a readjustment happening in the capital markets. And so if you're well-capitalized and you have the right relationships, we are talking to debt funds, we're talking to banks, we're talking to, all of the different sources of capital that you would think would be capital constrained. And we're not out there, trying to be vultures. It's saying, hey, can we be helpful, right? How can we partner? Can we create something where, we can create a win-win solution for you? We feel like we're getting strong risk-adjusted returns for our position, but also we're providing a solution, a long-term solution for people out there.
Yeah. No, I love that. Historically at PEG, we've, the DNA was originally development, which we still do, as you mentioned, especially on the BFR side. But we also have this big machine of, in-house property, all these different things that are really conducive to any sort of strategy that allows for additional assets within, under the umbrella. So to have someone like yourself come in and really kind of add additional focus to acquisitions, I think is super interesting and exciting. So I really like that. 2023 was a super tough year for capital markets. So please tell me this will change.
Yeah, look,
we're just about halfway now into 2024.
Look, private markets just take time to adjust, right? And they're just slow to adjust. And I can say, I spent the first few months of this year really traveling the world fundraising before I came here and, speaking to different regions of the world. Different parts of the world are in very different liquidity positions. And I think that there is more certainty out there with respect to where people think rates will be. People are starting to make allocations. I think, the denominator effect with where public markets are is kind of no longer an issue, but there still is an issue with respect to investors getting back distributions, right? Because there has been such limited transaction activity in the private markets that investors have not had the liquidity to redeploy like they expected. But it's starting to change. We're starting to see an uptick in M&A activity. We're starting to see an uptick in transaction activity. It's still down, but I think we're definitely headed in a direction where I think the capital markets people are starting to form capital in this new environment and to be able to take advantage of opportunities in this new environment. And so I think once that capital is formed, and it's something we're obviously focused on here as well, we're going to start to see more transaction volume.
Good, because again, things have to change, which I see it. Actually, the conversations have changed. There is not so much the sit and hold that I heard all through 2023. It's really, truly, I think the activity will pick back up again in the second half of the year. At least that's the way the conversations have been trending, which is, I think I heard in 2023, survive until 2025, right?
Yep.
But I do feel like that's loosening. I feel like we don't have to wait that entire time.
Yeah.
So that'll be good. Okay, so now we are halfway through, the year. You've been around the world. Everything that we just mentioned, the Fed is holding steady. Unemployment isn't going down. Inflation is ticking back up, and you got a stubborn Fed that's just not going to be doing anything, even though it's an election year. I was hoping for some reprieve. How do you see the rest of 2024 shaping up, and where do you see, the true opportunities?
Yeah, I mean, look, I think we are taking a very, I would say, conservative, but also active approach with respect to opportunities. And when I say conservative, I think we continue to not expect rates to go down. I think that there's a lot of people underwriting right now to make transactions work that assume long-term rates, drop over the next couple of years. And I think, that's not what the market's saying. And I think we're hesitant to pretend that we are smarter than the market right now. And so all of the data is pointing to things staying higher for longer. And so that's how we're underwriting. And we're not going to pursue deals unless it works within that context. I think the good news is we're finding deals that work in that context, right? So I really think that there are opportunities, especially in certain asset classes, as we think about, again, select service, extended stay hotels. I mean, just really interesting opportunities. We have such a strong
Which is
pipeline.
kind of new for you. I mean, not new for
new.
PEG, but it's
Yeah.
new for you.
Yeah. I mean, I financed a lot.
Sure.
Haven't done a lot on the equity side. Did more full service on the equity side. But this is definitely newer for me on the equity side. And it's really interesting,
I mean, it's definitely not as sexy as the full service, but it is. But if making money is sexy, then I think.
Look, the yields are high. It's like, the return profile, you can get 200 plus basis points more of current yield and, 300 basis points more of total return in an asset class that I think maybe isn't quite as defensive as Class A residential in a downturn. But, when you look at the data, it's pretty close.
Yeah.
And, you're doing it with leverage levels that are 20 percentage points lower than residential. So to me, that's a really compelling, risk reward proposition and, definitely something that's going to be a huge focus.
Yeah. Yeah. No, I've had a little bit of travel this year and I'm actually quite shocked at how much hotels are these days, just to stay anywhere in the country. So I definitely think that there's great opportunity there, and select service is definitely just the operating costs alone,
Yeah. I mean, just
there.
not having the amount of staff that's required, right? I mean, especially in some of these.
That's the big thing, right? Labor is incredibly expensive right now.
Yeah. And
hard to navigate.
That's what's tough. And that's part of what's tough even on the development side. And, in the credit markets, this is the same thing, right?
Yeah.
This is all compounding together to make it a tough market. It's costs, we haven't seen costs really soften across the board.
No.
I mean, they have in certain markets for some labor and some
Your
materials.
market is one of the worst, by the way.
Yeah. Well, in Phoenix.
Phoenix Scottsdale, it's terrible.
And the driver of that, which is really infrastructure spending, is what's keeping costs up, across the country.
Yeah.
And so there's so much infrastructure spending with the Inflation Reduction Act, way more incentives for government spending, private spending. So there, it shows no sign, at least yet, of slowing down.
Yeah.
And so that's kept costs high, and with interest rates high, and all of those factors, it's making things tough to pencil when you consider where wages are and just affordability generally. And you're starting to see that getting affected in consumer spending, and there's limitations to how high you can push prices.
Yeah.
And we're starting to see that.
We're starting to see that. Yeah. No, it's amazing to me. Utah is just always Utah, so it probably seems like a bargain to you. But even for these markets, I think people are shocked at what we're spending. So.
Yeah, I mean, look, residential prices in Utah, right, have skyrocketed. I mean,
Yes.
the
There's a land situation right here, so I think people tend to forget that we're only 3.5 million statewide, and it's only because we have mountains and canyons. Like, you just can't build. So I think it does affect our pricing differently.
Yeah,
we're not big.
Yeah,
at
you're
all.
land constrained.
Absolutely, yeah. But a lot of growth, and I think fundamentals here are really strong.
Yeah.
So I'm dating myself. I was here during the GFC, and not that it didn't hit us, but it was a blip. It wasn't bad. I watched the rest of the country just crumble.
Yeah.
And here, everyone's just, that conservative nature works out sometimes.
Yeah.
A little boring. But.
Yeah. Well, whereas in Phoenix, right, Phoenix was really the epicenter, right, in the GFC. And it's funny, I look at the neighborhood I live in now was one of the neighborhoods that was, you could have picked up for nothing in the GFC. It was like,
and did you buy 5?
No. Unfortunately, I bought like right after COVID. But that's when I had enough kids at that point where I had no choice. So look, it's what's happening in the residential sector, we're still focused there, right? The solution of affordability and the lack of supply is an issue.
Yeah.
And so
we're still catching up.
Yeah.
From 2008. It's just we're behind.
And I mean, right before this, right, Cam and I were on a call and we're sitting there and talking with somebody, and we're like, how can we bring what people want to them, in terms of product and do it in an affordable way, right? Everybody wants this kind of luxury resort type living.
But you have to pay for it.
But you got to pay for it. And everybody's, we're seeing it in the statistics of, people are maxed out. So, how can you kind of deliver affordable luxury, right? And
Affordable luxury.
How do you
This
deliver
is
that?
new.
How do you deliver that? And so
Is
more to
this
come.
more to come? Okay.
We're working on it, but I think, look, when you just look at the fundamentals, there's such a strong demand, right? And how do we meet the needs of the communities that we're investing in and do so in a way that provides kind of investors strong returns, but also really meets the needs of these communities is something we're super focused on.
Yeah. No, I love that. I love that. Again, in your 12 days here, you're not going to fundamentally change the way PEG does things, but obviously broaden our horizons and bring us new things, which we're going to have to talk about this affordable luxury, I think, on a future episode. Because I'm intrigued. So, and I think our listeners will be too. So, well, I super appreciate you sitting here, chatting, sharing, what you're doing and, helping us to better understand kind of this whole landscape. So your thoughts have been really insightful. And so I want to thank you for joining us today.
Me.
So in the meantime, thank you to all who have listened in today. I know that I had a great time with my new boss, and so I think we're going to hear more from him in the future. But from the peaks of the Mountain West, I am Rachel O., your host for Peaks and Portfolios, presented by PEG Companies, as we continue to dig into all things real estate. Have a fabulous day, everybody.